Okay, we have plenty of stock-specific action to track today. We'll get to that in just a bit. In our top 10 segment, we're looking at names like Dr. Reddy's, Z Entertainment, HDFC Life, SBI Life, ICICI Pru Life and LIC that are on our radar on the back of positive news flow. And there's Interglobe Aviation, ONGC, Oil India, Max Financial Services that are likely to open in the red. But do keep in mind that for companies like Interglobe Aviation, the fall in crude is a big positive. So that perhaps may, mitigate the negative factors there. Let's see how it goes.
All right. So there's views across asset classes. Jim McCafferty is global markets research. He's with Global Markets Research. Nomura is joining us right now. Jim, great to have you with us here. Back in the program. Thanks very much. Just a quick word, Jim, first on the big move lower we've seen in yields once again. Is this growth concerns playing out, or are these exaggerated moves in basically low volume markets? Because volumes have been kind of low, not just in rates markets, but in currencies, etc. as well. What's your view?
No, I think there's so much going on right now. And the key parameters, I think, are interest rates. I think it's absolute levels of debt, and I think it's inflation. And if you look at some of the movements on the currency markets, these are extraordinary times. If you go back to one of the headlines I spotted on your show prior to coming on, it talked about the UK sterling exchange rate falling relative to the dollar down to pre-Plaza Accord agreements in the 1980s. That's the kind of extremes we're at right now. And I think for a global investor looking to diversify a portfolio, now is the time to really look at the differences in the behaviors of consumers, governments, and corporates in the East relative to the West. And that, I think, means that Asia as an investment opportunity actually is a very good way of diversifying risk for the global investor.
Jim, good morning. Within Asia, we've seen a massive move in Indian market and at the expense of Chinese market. Do you think that trade could continue?
I think it's very likely, not really because of fundamentals, but because of global investor attitudes towards emerging markets. So if you perceive that you are a global investor set in New York or in London, you've got an opportunity set available to you, and you may have a mandate to invest in emerging markets. Now, if you have that mandate, you look at the composition of the index. The biggest single geography in the EM is China. India is far smaller. China is inexpensive on conventional valuation metrics. India, on the other hand, is quite expensive. However, what I think is happening is that a lot of asset owners and a lot of pension fund trustees are advising their fund managers that they do not want exposure to Russia, for example. And China, of course, is a physically proximate geography to Russia and shares many of the, let's say, ideological identities that Russia has. And therefore, China has been put in that basket that makes it very hard for many international investors to get involved. So I think that's what's been driving the behavior so far. Now, in terms of China's fundamentals, clearly the COVID situation is very different in the way it's been handled relative to other geographies around the world, and that's causing GDP growth rates to come down. But China, nonetheless, does have a vast number of metrics and tools it can use to manipulate policy and the outcome of that. But until we see that in action, I think for now, India is probably going to be a beneficiary of what's happening in China.
Actually, that has been the case so far, right? I mean, India has outperformed in a big way, not just compared to China, but other markets like the Dow, the S&P, even Europe. Do you think that outperformance is something that can continue? And if you had to allocate money now, Jim, where would your preferences lie globally?
So I think if we look at the MSCI Global Index, the biggest single market, of course, is the US. It's 60% of that geography. The second one is Japan. Now, Japan has, on a local currency terms, delivered almost a positive return so far this year. But in terms of the US dollar return, it's been absolutely dreadful because the yen, of course, now is at 144 to the US dollar. So I think if you look at Japan, couple of ideas that we'd identify. One is we've got the country beginning to accept foreign tourists. I'm actually traveling to Japan next month as part of a visa program. So tourists are getting back into Japan. The currency is very cheap for international tourists, and especially US tourists, with the dollar's been strong. So I think you've got that kind of domestic stimulus associated with the tourism boom that we're expecting in Japan. But the other thing, of course, is we're now seeing Japanese policymakers identify the fact that the currency has been weak and possibly signaling that the Japanese authorities will do something about it. Now, this goes down to central bank independence. And of course, the BOJ, relative to many central banks around the world, is perceived to be fiercely independent. But we do have a change of leadership coming up in the beginning of next year, and that might signal more intervention in the currency markets, which could actually be helpful for Japanese equities.
Jim, I was reading that Citi's Ed Morse, who tracks energy for them, in an interview yesterday, was saying that European energy prices may only come back to 2021 levels before all of this happened. I mean, the gas supply issue, etc., started sometime in 2027. I mean, that's a long time off. That was his opinion, of course. What do you make of the situation there? And and that's one large leg of global growth, right? Or rather, lack of global growth. Is it going to stay like that for many years?
I think this is a real live issue, and be mindful that many of the companies that we follow here at Nomura in Asia Pacific are dependent on demand and trade from European geographies and, of course, the US. And I think going back to what we talked about at the beginning of the interview, we talked a bit about debt. And one of the major issues we have with Western economies, including the US, the UK, Germany, France, etc., is not just the level of consumer debt, but the level of government debt and the level of corporate debt. And all of this issue about energy prices, that will feed into the inflation metric. Now, if we've got inflation going up and we've got a toxic level of debt amongst consumers and companies which are having to refinance things, then that does not bode well for markets, for equity markets. Asia is completely different. And if you look at MSCI Asia Pacific, biggest markets Japan, number 2 is China, then you've got Korea, you've got Taiwan. More than half of the big listed companies are sitting on net cash, which I think means that for investors looking at this set of optics ahead of them, I think it means that as for markets, the safety will be in Asia.
Okay, the safety will be in Asia. This fall that we've seen in crude, right, just to take that point forward, I mean, crude is now down 35% from the highs we saw in July. Has that been factored into your upside scenario for markets like India? Because it is a big tailwind for oil importers like India.
I think you're absolutely right. So the two big markets in Asia Pacific, which are heavily dependent on overseas supplies of gas or oil, Japan, of course, and India, right? So they are big beneficiaries of lower input prices. And for that reason, we may see analysts start upgrading estimates as these prices filter into the supply chain.
All right, Jim, we'll leave it at that. Thanks a lot for joining in and speaking to CNBC TV18. That's a word coming in on the global markets. Let's dip into a quick break. On the other side, our list of top 10 stocks coming up. Stay tuned.